So the investment strategy at EMA is that through the use of asset allocation techniques, we attempt to deliver a complete institutional investment solution, but to retail investors. As I mentioned earlier, EMA portfolios have individual holdings of usually between 12 and 15 exchange-traded funds, or ETFs. But when you look through the ETF and the individual holdings, an example would be an ETF which tracks the S&P 500 index would have 500 holdings. So our portfolios generally have underlying holdings of approximately 7,000. The value to investors is high levels of diversification reduce single stock risk. Our investment philosophy, rooted in academia and nurtured by real-world experience, starts first with strategic asset allocation. That is, considering an investor's time frame and willingness to accept risk. It's followed by tactical movements within permitted strategic ranges, and that is supplemented by an opportunistic element that seeks to take advantage of market dislocations. Digging a little further, strategic asset allocation takes the individual risk tolerance of an investor and pairs it with their time horizon, looks at the historical performance of various securities indices, and determines the optimal combination that would have, in the past anyway, produced the highest level of results. But the future doesn't always replicate the past. And that's where tactical asset allocation comes in. Tactical asset allocation is the implementation of the opinions of the investment managers. It can also be based on various technical signals or macroeconomic analysis of the business cycle. It can also look at the various valuation metrics of individual security indices or industries or sectors. All of these metrics come together and they permit a manager to make adjustments within a strategic framework that is developed in the investor's investment policy. Finally, the opportunistic element, which at EMA is between 0 and 10% of our portfolio selections, represents our best ideas at any given time. Something unique or unexpected happened real time in the financial markets that caused an investment asset to be undervalued, might cause EMA to buy it, or to be overvalued, might cause EMA to sell it. Or maybe there's just general disruption in the marketplace that causes securities markets to go way up or way down beyond their trend. It might cause EMA to rebalance the portfolios opportunistically. The combination of strategic, tactical, and opportunistic asset allocation techniques are the basis for the construct of the EMA ETF portfolios. Our investment philosophy, first, as I said earlier, is rooted in academia in the efficient market hypothesis, largely originally attributed to an economist in the early 20th century named Alfred Cowles. It states that it's difficult for any stock or bond investor to consistently or predictably outperform their asset class benchmark. It's the reason we named our firm Efficient Market Advisors, and it's the reason we're an active manager of passive products, low-cost ETFs. We then follow that up with the implementation of modern portfolio theory. Modern portfolio theory has its roots back to the University of Chicago, work done in 1951 that later won a Nobel Prize for an economist named Harry Markowitz. Harry theorized that for every level of risk, there's an optimal combination of asset classes that is expected to produce the highest return. We take it a step further. We say it would have produced the highest return in the past. People who believe in pure strategic asset allocation tend to stop after the implementation of the efficient market hypothesis and modern portfolio theory. We believe there is room for tactical adjustments to portfolios that are constructed using the first two things. Then we like to look at the lowest cost asset access to an asset class or category. We believe that costs matter It's why we use ETFs, and it's why within ETFs we often gravitate towards the lowest cost producer, the lowest cost access to the beta in the asset class. And finally, we believe strongly that taxes matter. Not only are ETFs more tax efficient for investors than traditional mutual funds because they don't generally distribute capital gains, but we also look for tax loss harvesting opportunities within our taxable portfolios, attempting to deliver to investors not only a low cost and low turnover, but a low tax generating portfolio to the extent that we can. The result, 15 portfolios. All 15 of EMA's portfolios own the exact same securities. So the taking income portfolios are our three most conservative. Within our most conservative taking income portfolios, we offer tilts. Investors can be conservative, moderate, or aggressive. But even the aggressive taking income portfolio is less risky than the 2 to 5 portfolios, 6 to 10, 11 to 19, and so forth. The name conservative or moderate aggressive is only representative within the time series. That's the strategic element. So, taking a look at your own time horizon, thinking of where you might be, and the time horizon we use is the time frame before which you will begin to take investment distributions. If you're taking investment distributions, you're probably looking at the taking income portfolios. As I mentioned, all portfolios own the same securities, but they own them in different amounts because we're attempting to achieve different returns, and we're attempting to produce those returns with different levels of risk or volatility in each of the portfolios. To construct this in another way, think about that efficient frontier I told you about from the efficient market hypothesis and Harry Markowitz in the University of Chicago. Harry, by the way, is not affiliated with EMA. The graphic representation of his work is called strategic asset allocation, represented here by this green arcing line. But our investment policy allows us to make moderate and modest tactical adjustments, allows us to allocate assets both above and below that efficient market line. And finally, our opportunistic part of our investment policy allows us to make opportunistic bets. This is a way of graphically depicting the three-part process by which EMA constructs portfolios. We are strategic, tactical, and opportunistic. Finally, our investment portfolios are constructed by a committee of individuals. These individuals have combined 97 years of portfolio management experience. I'm the gentleman on the left. I'm Herb Morgan. I have 29 years of investment experience. I'm joined on the committee by Jeff Anderson with 27 years, Glenn Umbach, our CFA and senior portfolio manager with 16 years, and Austin Crow with 35 years of investment management experience. EMA has one of the longest pure ETF track records in the space. Morningstar puts out a ETF Managed Portfolios Landscape Report, and in the report for the period that ended December 31st, 2015, there were 750 ETF strategies being reported. Of those 750, only 546 were pure ETF strategies. The rest were hybrid and included other things beyond ETFs. Of those 546, only 346 claimed compliance with the global investment performance standards that I talked to you about at the beginning of our presentation. Of those, only 202 can claim that compliance for at least 5 years, and fewer still, 125, claim that GIPS compliance for 10 years. I'm pleased to tell you that 15 EMA portfolios, pure ETF strategies, claim compliance with GIPS for at least 10 years. EMA frequently receives mentions in different media. I've been a guest on CNBC television and Fox News, and we're frequently quoted in different areas. In addition, I currently write a column for the ETF Strategist channel, a division of ETF Trends. I want to thank you for taking some time to learn a little bit about efficient market advisors today. I want to encourage you to contact your financial advisor if you have further questions or perhaps have an interest in investing with us. If you also have further questions or your financial advisor has further questions, they can contact EMA directly. Talk to a member of our sales team. Our phone number is 888-327-4600. Again, thank you for joining me today. I appreciate your time and attention.